Joining us now, multi-award winning portfolio manager Keillen Ndlovu from Stanlib, and of course my co-host David Shapiro is still here. Keillen, thank you very much. Just looking at the recent spate of results we've had from South African listed property companies, what would you say is the overarching trend across the board? Is it easy to establish one in the first place?
I'd probably say it's kind of a mixed picture. You've seen a diverging trend in terms of quality of properties, with the stronger shopping centers, like the bigger shopping centers, doing better than the smaller ones. So it depends which company is actually exposed to the weaker sector, and the hotel sector being the hardest hit. But if you look at the income growth of about 6.8% average during this result season, it's been fairly good actually, but out too cautious.
Yeah, in fact, it's quite, it's actually, what's the word, mimicking the economy. Mm-hmm. If you look at hospitality, which a few years ago, just before the World Cup, was one of the hot property stocks,
yes,
etc., particularly hospitality.
That's right.
And it's turning out to be a bit of a disaster. And with Sun International's results today, where do you place yourself with hospitality? Is it still on your list?
We're actually underweight at this stage. We don't own any hotel shares. Because if you look at it, just give you an example, just around us here, how many hotels have you seen? And the supply has increased by over 50% in the last 4 years or so.
Well, we were talking about the closure of the Grace a little earlier in Rosebank. I mean, that's a stalwart in the Johannesburg or Gauteng hotel industry.
That's right, yeah.
Keillen, does it affect any other property trusts?
There's one counter it's probably hospitality with a big hotel portfolio. Other ones only have 1 or 2 hotels. But it did affect Hyprop because they own the Grace Hotel.
Hyprop you highlighted as disappointing.
Yes, Hyprop disappointed us because of the hotel exposure and also the office exposure through Siacom.
They're converting those to offices, but that will probably take time to let out and so on.
Yeah, they're probably looking at about next year to get another operator to come through there.
One of the other disappointing numbers are Emira, you highlighted. What happened on that front?
It's a quality of the portfolio. They own secondary properties, secondary retail, secondary offices, and they've got the highest vacancies in the office space. So you're probably thinking that the economy is going to grow and they'll benefit from that, but it's not coming through.
How would that, and what about Resilient, who's also...
have they been resilient?
Well, Resilient's interesting because most of their properties are on the outlying areas. It's it's quite a unique type of property trust.
So as the name says, they have been.
They
delivered about 9% growth, and they say it actually is quite a dull year for them. But strange. That's what the CEO said. It's a dull year. So going forward, they're looking back at 10% income growth. So the market
Growth Point out last week. We had Norbert Sasser in studio. Anything worth noting on that front?
The numbers are good as well, the income growth, but the outlook, they're more cautious. They've actually trimmed down their guidance. It's kind of a wider guidance, 3 to 7%. It shows you how actually uncertain the environment can be as well.
Because they've got the Victoria, they've got the V&A down in Cape Town, I think, which is going to use a lot of development in that. Yes. So I suppose if you want to take Growth Point, one's got to wait for yields down the line. You've got to take a view, almost like a development view.
Yeah, it's more of a long-term story because one, there's going to be debt that they need to actually use to fund the V&A, so that will dilute some of the earnings, and the office portfolio as well. If you look at most of the companies, the office portfolio is quite a big headache.
When you say it's a long-term play, would you be picking it up at current levels at 18.60?
It's fairly valid at this stage. We do hold Growth Point, and we're slightly underweight, but we like the quality of the shopping centers. Over 80% of the shopping centers, it's dominant shopping centers, and management good as well.
I want to know, what do we buy, what do we avoid?
Well, I just want to remind you that the last time that we interviewed Keillen, you were in studio, and you said Capital was your pick. Now it's done very well for you, hasn't it?
Capital's done well.
And they just paid the dividend about... Sure.
When Keillen told you to.
Yes. And they just paid a divvy, an interest payment about 2 weeks ago, and you've got to come that as well. Yeah.
Yes, actually talking about that, they've paid the dividend, but the price is back to where it was before. Because
so I got that for free.
11%
well, you see, you must have actually done that directly after Keillen told you to buy. That's why you know so much
everybody else
about
could have
Capital.
done it as well.
Exactly. So besides Capital, is there any other value out there at the moment?
We did mention Vogile last time.
Yes, you did.
It's trading at over 9% forward yield compared to the sector at 8.4%. And the growth is we're looking at about 6-7% growth, which is above what we're looking for the sector as well.
The outlook going forward now, what do you think? We've just heard from Dennis saying he's expecting GDP to come in at about 1%, muted growth for the second quarter. Does that mean that the trend for the second half of the year is going to be in line with that GDP number, the bleak GDP number that Dennis has put on the table?
Yeah, it is a concern, mostly for sectors like the office market, because you need to see the GDP come back strongly, the economy pick up. But retail depends on where actually salary increases are going to come from.
I'm going to ask one other one, and this is the one that's worrying me,
Yes.
is the industrial side.
Sure.
If we looked at manufacturing numbers
Yes.
over the last quarter, they've really been under pressure. Manufacturing results. Are there any trusts here or companies that are exposed to manufacturing, to factories, that we should be cautious of, or
actually
putting out a signal?
The interesting thing about industrial, it's actually changed actually. We moved away from manufacturing more into warehousing and distribution. So most of that is actually linked to the retail sector. And so we've seen industrial actually holding up. And the nice thing about industrial as well is limited land. It's difficult to build industrial now. You can't get power. And so it bodes well for the industrial.
So there's
there are
limited
no red
capacity,
flags,
you're
yeah.
saying, from the
Yes.
industrial perspective.
Sure.
You mentioned earlier that you were looking as to where salary increases would come from,
Sure.
because that's going to impact your retail sector. Are you concerned?
Well, actually, if people are still getting 18% salary increases, good for it, they go and shop. But we have to be more focused on the bigger, dominant defensive shopping centers.
What about Sandton City?
Yes.
When are we finally going to go there where we don't have to detour and go through other... When are you going to stop building there?
There's a couple of phases, so probably end of the year for phase one, so probably to clean that up, and then there's probably another phase coming through as well. So by the end of the year, then...
I did the original audit of Sandton City when it was formed in 1970. That's when I was doing auditing.
You're showing your age.
No,
David, this
I'm
is
not
a scary
young.
thing.
I'm a very old man. And ever since I did that audit, they've never stopped building and adding on, etc. And one day I just want to drive in there and say, no detours, all the parking is available, and so on.
But people still go to this issue. But it did affect their foot count. They're down about 1%. Turnover's probably up 4 or 5 there about.
Which of the stocks are most exposed to Sandton City while we're doing this on-ground analysis?
Well, actually, Sandton sits in the unlisted space. It's owned by Liberty Properties. But if you look at proxies as well, if you want to have bigger dominant shopping centers, it's your Hyprop. Hyprop's got the biggest portfolio. They've got Canal Walk. Now they've got Woodlands Boulevard. They've got Clearwater Shopping Center. They've got the Glen as well. So it's a nice proxy for dominant shopping centers in the listed space.
And just one more question on interest rates, considering it's key to property going forward. There's a lot of debate now as to where interest rates are going in South Africa. Do you think we're going to see another cut?
Well, actually, if you look at where the economy is as well, personally, my own view as well, I don't see actually rates going up at all. So probably flat, and the possibility of a cut. You need the economy to come back.
But that makes them much more attractive.
Yes.
No, well, that's what I'm saying. It's key to the property sector.
The FRA market, the forward rate markets, are discounting a 50-point cut, I think January or February, if you look down there. So certainly the market's bringing in a position.
So the timing would be good now to get into listed property?
It would be good for that. In terms of funding for the companies, lower cost of funding, and that means more money in the pocket for people to go and shop as well, and for the economy.
Just going back to Capital and Vukile, still good buys at this point in time?
Yes.
We'll keep holding you to them.
Sure.
They're working for you right now.
Watch out for
Keillen, thank
them.
you very much for your time.